When global crisis hits, do you panic sell or buy the blueprint? Stop funding the panic machine!
Let's be real for a second. If news of a major global conflict breaks tomorrow morning, what's the very first thing you're going to do? I mean, before you even call your family. You're probably going to open your brokerage app. It's almost a reflex, right? That's what financial anxiety does. It grabs our most primal instincts and just points them straight at our portfolio. But here's the thing. While most people are smashing the sell button on their index funds, someone else is doing something that looks, well, completely insane from the outside. They're buying. And they're not just buying anything. They're buying specific things in a very specific order based on what actually happens to money when the world goes sideways. So, let's get into it. Here's our roadmap for this whole explainer. First, we'll look at the two choices every investor has: panic versus having a plan. Then we're going to pull back the curtain on the financial panic machine, the system that actually profits from your fear. After that, we'll dig into this seriously counterintuitive history of how markets behave during wartime. Then we get to the good stuff, the detailed 6-step wealth blueprint. We'll see how it plays out with two different investors and wrap up with the most important part, when you actually need to make your choice.
All right, so here's the most critical point right up front. When a crisis hits, you have a choice. You really do. It's this fundamental fork in the road. You can go down the path of a pure, gut-level emotional reaction, or you can take the path of a disciplined, prepared strategy. And believe me, that one single choice is going to determine literally everything that happens to your money from that point forward.
To bring this to life, let's imagine two investors. Let's call them Mark and Sarah. So on the left, you've got Mark. The second that crisis news hits, his gut instinct screams, sell everything. He's reacting, he's trying to do something. Now, on the right, you have Sarah. The exact same news alert pops up on her screen. And what's her first move? She calmly gets up and makes a cup of coffee. You see, her lack of action is an action. It's an action driven by a plan she already had in place. So let's dig into this a little more. Mark, he's got a $40,000 portfolio. He immediately glues himself to the financial news channels. He sees that red crisis banner flashing on the screen over and over and over again. And by 9 a.m., he's done it. He's sold his entire portfolio. And you know what? He probably feels this wave of relief, like, phew, I took control. Meanwhile, Sarah has the exact same portfolio size, she sees the same alerts, but she remembers one single critical piece of data: how the market has historically behaved in these situations. So she just turns off the TV and goes about her day, letting her plan do the work for her. From this one moment, their financial futures are going to go in completely opposite directions. Now, to really get why Mark did what he did, you have to understand the system that is specifically designed to get that exact reaction out of him. I mean, it is a well-oiled machine that doesn't just report on your fear, it actively creates and packages a sense of urgency around it. So let's take a look at how this thing is actually built. This right here, it just says it all. It's the business model in a nutshell. And look, this isn't some conspiracy theory. It's just the operational reality for a huge part of the financial media. The more scared you are, the more you watch. And the more you watch, the more ad revenue they can generate. Your anxiety, your panic, it's literally their product. So here's how the cycle works, step by step. First, some real-world event happens and tension spikes. Second, the media frames it with the most extreme, terrifying language possible. A normal 2% market dip isn't just a dip, no, it's a free fall. Why? Because that word makes you click. It makes you watch. Third, all those clicks and eyeballs translate into soaring viewership and engagement. And fourth, that engagement gets sold to advertisers, who are often the brokerage platforms that are more than happy to help you make those panic trades. For a fee, of course. The whole ecosystem profits when you do the exact wrong thing at the exact wrong time.
Okay, so if reacting to the panic machine is the wrong move, what's the right one? Well, the answer is to ignore all that noise and just look at the data. And we're about to dive into the deeply, deeply counterintuitive history of how markets actually behave when the world is in conflict. I gotta warn you, this is a story that just feels wrong in your gut, but the numbers, well, the numbers don't lie.
This is it. This is the question that Sarah had an answer for and Mark didn't. Our intuition, our gut, screams that war is destructive, it's chaotic, it's terrible for business, so obviously the stock market has to just collapse, right? But the historical record tells a completely different and frankly pretty shocking story. Just look at these numbers. I mean, really look at them. During World War II, the Dow Jones gained 50%. 50%. During the Korean War, it went up 60%. And even over the long, painful slog of the Vietnam War, it still saw positive returns. And if you zoom out, The S&P 500 has delivered positive returns within 1 year after a conflict starts, nearly 3/4 of the time. Think about that. The market doesn't just die in wars. It dips, it panics for a few weeks, and then, almost without fail, it climbs. At this point, the market is basically a cockroach in a suit.
So why? Why on earth does this happen? Well, it all comes down to simple economics. From a purely financial standpoint, wars are the biggest, most aggressive government stimulus programs imaginable. I mean, think about it. A country at war spends whatever it takes on weapons, fuel, logistics, medical supplies, everything. The government becomes the world's biggest customer overnight, and they're not clipping coupons. All that money, all that spending flows directly into the revenue and earnings of publicly traded companies, which, you guessed it, boost the stock market.
Okay, so we know not to panic. And we know that history tends to be on the side of investors who just stay in the game. Now, let's get tactical. This is the heart of it all, the deliberate 6-step blueprint that someone like Sarah would follow. And this isn't about trying to perfectly time the market bottom. It's about structuring your portfolio for resilience and, yeah, for opportunity. So at a high level, this is what a crisis-ready portfolio structure can look like. You can see it's not just your standard index funds. We've got dedicated slices for a cash floor, for hard assets like gold, and for sectors that historically just do really well in these environments, like defense and energy. We also have defensive plays like consumer staples and a really crucial hedge against inflation. Now let's break down each one of these pieces step by step.
And the order we go through this is critical. We start with the absolute foundation, cash. Before you even think about investing another dollar, you need a cash floor of 6 to 12 months of living expenses, period. And that should include a small but vital amount of physical cash. I'm talking $2,000 to $5,000 tucked away. Why? Because cyber warfare is a very real thing. Remember when Russia was cut from the SWIFT system? ATMs stopped working, not because the money vanished, but because the digital plumbing got shut off. This physical cash is your insurance against that. But, and this is super important, you stop there. Wars are incredibly inflationary, and sitting on a huge pile of cash is a guaranteed way to lose your purchasing power.
Okay, next up is gold, but probably not for the reason you think. See, most people rush to buy gold during a crisis, right when fear is at its peak. That's usually a mistake. Gold tends to spike on that initial fear and then give a lot of those gains back. The much smarter play is to already own it before the crisis hits the headlines. What's really interesting right now is that gold's strength isn't just about fear anymore. It's about a structural demand shift. Since 2022, central banks all over the world have been buying gold at record levels to diversify away from the US dollar. That's a long-term institutional change. For most of us, the easiest way to get this exposure is through low-cost ETFs like IAU or SGOL.
Step 3, defense. Now this is a trade that history basically hands to investors on a silver platter nearly every time. This chart just says it all. In 2022, while the S&P 500 was down a painful 18%, the defense sector ETF XAR was up 10%. That is a 28 percentage point outperformance. It's huge. And this isn't just a short-term blip. It reflects a decade-long structural shift. Nations are rearming, defense budgets are soaring, and these companies have backlogs of orders that are going to take them years and years to fulfill. Step 4 is energy, which follows a very predictable script in a crisis. A conflict breaks out, it restricts supply, panic drives prices through the roof, and energy companies make enormous profits. The difference in performance can be just staggering. Look at 2022 again. The S&P 500 lost 18%, but the main energy ETF, XLE, gained 64%. That is a massive 82-point gap in a single year. While the news was all focused on tech stocks getting crushed, this was the sector that was quietly making people a lot of money.
And finally, we've got our 2 defensive plays to round things out. Step 5 is consumer staples. People don't stop buying toothpaste and toilet paper and Tylenol during a war. These stocks provide a really reliable cushion for your portfolio. Then, step 6 is inflation protection. Now here's the trap. Most people hear safe haven and they immediately think government bonds. Wrong. During World War II, Treasury bonds lost 67% of their real value after inflation. Wars are inflationary. The correct tool for this job is Treasury Inflation Protected Securities, or TIPS, which are specifically designed to hold their value when inflation is on the rise.
Now, listen up, because this is the single most important rule in this entire blueprint. After you've set up these tactical positions, you do not, and I repeat, do not touch your core holdings, your broad market index funds like VOO or VTI. You leave them alone. Remember, the war economy is a stimulus economy. The data actually shows that large-cap stocks return higher than their peacetime average during major conflicts. So you leave your automatic contributions running. You keep buying every month just like always. A market downturn is the best time to be acquiring high-quality assets at a discount.
Okay, so we've laid out the entire blueprint. Now let's circle back to Mark and Sarah and see what the real-world financial consequences were of their two very different paths. This is where that gap between having a plan and just panicking becomes devastatingly clear.
This slide just lays it all out. They both started with $40,000. Mark sold everything, he sat in cash for months, missed the initial market recovery, and then he had to pay capital gains tax on his sale, which permanently locked in a loss. His $40,000 eventually grew to about $48,000 over the next few years. Sarah, on the other hand, did nothing with her core holdings but made those tactical additions to defense and energy. She paid no extra tax, and her $40,000 grew to roughly $91,000.
$43,000. That's it. That's the number. That is the cost of panic. Same starting point, same scary news alerts. The only difference was that one person had a plan and the other person reacted to the fear being sold to him by the panic machine. Sarah didn't win because she found some magic stock. No. She won because while Mark was sitting in cash, losing ground to inflation, she was methodically buying quality assets at a discount. She was buying the fear that Mark was selling.
So this brings us to the final and most crucial point. All of this information we've gone over, it's totally useless with action. The decision to be a Mark or to be a Sarah, it's not made in the heat of the moment. It's made today, in the calm. It's a choice about your future.
So let's just end with this thought. One day, your phone is going to be blown up with red alerts. Some analyst is going to be on TV explaining with a very serious face why this time is different. And in that moment, there are two paths. The person without a plan opens their brokerage app and sells everything. The person with a plan checks their portfolio structure they've already built, puts their phone down, and makes a pot of coffee. One of those people builds wealth. The other one just funds the very system that's designed to stop them. The time to decide which person you're going to be, it isn't when the missiles are flying. It's right now.